Hello viewers, welcome back. We are now looking at the enterprise value and the equity value. So what we have done in the last exercise is we've tried to calculate the enterprise value. We've calculated the enterprise value for the company. And you can see here on the right hand side, this side on the right hand side, we've computed that enterprise value. We've computed that enterprise value where we have the enterprise value of roughly 100 and we have the enterprise value of 130 from this point here. This is where our enterprise value is 130. Now, the enterprise value really represents our view of the company's value. In other words, we are the ones who've computed this, who have done the valuation. So we've gotten our enterprise value as per our computations. Now, that is going to represent our view of the company's value. So if we have built the DCF model and the DCF is telling us the enterprise value, so if we have built the DCF model and the DCF model is telling us the enterprise value, then that's really our own view of the company's value. In other words, the computations we did, those are the as per our computations. Now, although the enterprise value is going to be a key metric that we look at, and it is easy to use it to compare against other companies, it also might be interesting for us to calculate the equity value. And the way we are going to compute the equity value is we are going to take the enterprise value, we subtract the net debt, which is roughly 34,000 US dollars, and that will give us an equity value of around $96,000, this value here. So it is really great to think about a piece of real estate. Let's try to think about this in terms of real estates, because it will be the one that will help us to understand the difference between enterprise value and the equity value. If we owned a house that was worth 100, and if we owned a house that is worth $130, so meaning the whole house is worth $130, then the net debt is like the debt we have, let's say, to the mortgage. Let's assume that maybe we have a mortgage of 34,000 US dollars, and that's the mortgage that we have. And that would mean that this net debt, or in other words, the debt is going to be offsetted from the 130. So for us to get the equity portion, we shall get the enterprise value of 130, we less off the debt or the mortgage of $34, and this will give us 96,000. These are dollars. So that $96,000 is the worth of the equity section in the house. In other words, we borrowed $34,000 US. But we have a house that is worth $130 US, meaning the 96 is actually equity. So that's the implication from that perspective. So that is the implication of that. And another way you can think about equity value is actually it's our residual value as owners. What has remained after we've cleared all the debt components. For instance, if we were to sell the house, let's use another scenario here. Same information, but in a different perspective. Our house, we will say that our house is worth we will say that our house is worth that is the house, and it is worth $130 US. We find that we are now going to pay off our mortgage. We can sell this house at $130 US, but we can pay off our mortgage, the debt of $34,000 US, and that is going to leave us with a residual amount, and that residual amount of $96,000 is worth our equity. In other words, that is the residual amount that has been left there. Now, we want to also make sure that we understand how to calculate the net debt, because we have understood how to make these computations for the equity. But now we want also to look at this scenario of how we can be able to compute the net debt. The net debt, actually we have a formula here. For our net debt, the formula is here. Now, we have up here on the top, this top right corner, we have taken a debt of 45,261. This is the debt. And now we've subtracted our cash. Cash is $11,246 US. And that gave us a net debt position of $34,015 US. That is the net debt position. That is the net debt position that we are in. Now, the way to think about this net debt is, if you had $45,000 US worth of debt, and you had the cash, maybe you went and borrowed $45,000 US, but with you had the cash of 110, 11,000. Let's just take 11,000 of debt, of cash. Now, you could use the cash to pay off part of the debt. This cash that we have, the 11,000, you could use cash to pay off part of the debt, because you borrowed 45,000 and you have cash of 11,000. And you could use that cash to pay off that portion of the debt, and that would leave you with a net debt of $34,000 US. Just take it like this. You have a loan in the bank and you've gotten some cash. They are demanding you 45,000, but you've gotten cash 11,000. So the whole idea is that you go and pay off the cash you have to the loan, towards the settlement of that loan, and you remain with the balance of debt. In other words, the net debt is equaling to the total debt, all the debts that we have, total debt minus whatever cash we may be having. and that will give us what we call the net debt. That's what we are seeing from this point here. So that's how great you can be able to think about that net debt. Now, let's take some time and look at the equity value. We throw more lights on the equity values to see what we can actually have from there. So now, equity value, we want to look at equity value. So equity value, we normally find this under public companies. So public companies can be more complex than pieces of real estate, as we've clarified earlier, in a sense that public companies would have shares outstanding. They have shares outstanding. So if we go forward, we might want to understand equity value as, first of all, the value that the equity holders are entitled to. But we might want to look at how to calculate the equity value per share. The equity value per share. Just know for equity value, that's basically the shares, the equity holders, what they are entitled to. Now, what we would do in this case, if we are trying to get the equity value per share, we would take the total equity value, we divide it, this is total equity value, we divide by the number of shares outstanding. In this case, we could see that roughly 25, these shares outstanding, they are roughly 25,000 shares, and it would give us an equity value per share, which is roughly 3.7 per share, the equity value per share. Now, if we have gone through the process of building the DCF model, and we have selected the input that have gone into that model, then this 3.7 you are seeing from this side, 3.75, represents our view. The 3.75 represents our view of the company's equity value per share. But what we can do as a final piece of analysis is compare our view of equity value per share of 3.75, and we can compare that to the market price, what is prevailing at the market. We compare that with the market price or the current share price. We've seen that the current share price here was 3.14 per share. That is the equity value per share, the current or the share price per share. Now, we can now see that here our view of the value is 19.4% from this side, higher than the value where it's trading in the market. In other words, when you get the 3.75, minus the 3.14, that is 0.61. That gives you a percentage of 19.4 of the, meaning it is already higher than the value we are using, or that is the value that is prevailing in the market. Meaning we valued our company and we found that our shares are actually 3.75. But when you go to the market, they are actually buying those same shares at 3.14. Meaning for us, we overstated our values by 0.61 cent. In other words, by 61 cents or 0.6. So, meaning our value are now higher than the market value. So, we have, what we have really done in this process is we have calculated our own view of the company's equity value. And then we have compared it to the stock market price. And this is where we could encounter an opportunity. It's either we get an opportunity or we find it's a loss. Because if our view is correct and the stock market is incorrect, then we have the opportunity to make more profits of 19.5. Because what does this mean? What this means is that this percentage you are seeing, of 19.45 is actually making us to have a profit. That's why you are seeing we have a premium of 19.4 of 19.4%. And that premium comes as a result of these small differences that we are seeing here. So if this is our view, if this one is correct and this one is wrong, the implication here